Hello, hi, this is Arvind here. Let's look at the market view and trade setup for the third week of February. So, as you can see this chart, I had also shared this chart in my Facebook page. So you can see Nifty is contracting into a narrow range, right? So it is testing the borders of these two trend lines, and right now it is somewhere here. There's a good chance that it will test the bottom of this trend line, which is around 17,200. So 17,250 will be intermediate support, and if that is breached, this will be the possible trend for Nifty. So it's contracting into a narrow range. So I'm expecting some kind of sideways consolidation with a negative bias for the coming week. So we can maintain sell-on rally approach. So any kind of rallies towards 17,300 to 450 kind of, this could be resistance zone because there's a gap which is got created here. So that will act as a resistance zone. So until 17,460 is cleared, any kind of rally should be sold into. That is my approach for the coming week. So I'll be looking to buy some puts or sell OTM calls. That is my view for the week. But the overall market structure is looking a little bit weak given the global cues are also weak. There is a good chance that we may break this trend line and test lower levels. 17,050 and 16,840, that will be the two support zones. So you can see this is also the lower end of Bollinger Band. That will act as a very strong support here. So I'm looking to short the market, any kind of rallies towards here. There's a good chance it will break this zone and it will test 16,800. So this could act as a resistance zone. You can extend this trend line, you can see here. So any kind of bounces should get sold into. So I'm going to maintain the negative bias for the coming week till February expiry, unless 17,500 is cleared on the upside. You see 20 DMA is falling. That will be as a very crucial support. Unless 20 DMA is taken out on a closing basis, we can continue to maintain a sell-on rally approach. This will be a strong resistance zones to clear, right? So that is my view on the Nifty. Coming to Bank Nifty, 38,200 at the 20 DMA somewhere here, closing above 38,200. We should maintain a negative bias. So let me just expand this. So this is 38,200 and 100 DMA is at 37,700. So probably we'll open gap down somewhere here and any kind of pullback rally should get sold into. So you can see there's a trend line or support here. If this is breached somewhere around 100 DMA, then we will see lower levels, which could test 37,000, 37,200 on the downside. So both the indices are sell on rally approach for the coming week. Now let's look at the US markets. All three major indices closed negative. At the lowest point of the day, you can see Nasdaq shared about 3% and looks good to test the lower end of Bollinger Bands, which is still let's see, can be expected in Nasdaq. The same pattern can be seen in Dow Jones and S&P 500. So we can maintain a negative bias on the global front. So we can see 20 DMA is again acting as a resistance zone. Similar pattern in Nifty, you can see this evening star kind of pattern and further fall. So this is the kind of candle we can expect, say tomorrow or day after. This is DXY. You can see it took support, had the 100 DMA and is bouncing back. You can see here clearly it had a good fall from the base here and is taking out the 20 DMA. So it's a very good chance it will go towards 97. That's not a good sign for emerging markets. So this is a negative sign. You can see here one more negative. There's a good chance it will take out this 75.5 resistance zone and head higher towards 76, 76.5, which will again be a negative for Indian markets. So SGX at 100 case, we will breach the trend line support, right? You can see here this trend line support. If it gets taken out on the downside, there's a good chance we'll test 16,860, which is also the lower end of Bollinger Band. So there is a negative bias in all the charts that we have seen so far. So good to maintain a negative bias unless the previous day close is taken out. Previous day high is taken out on a closing basis. So 17,450, it's also 20 DMA. Unless this gets taken out, we have to maintain a negative bias somewhere here. This is the Friday high. So until this is taken out, we have to maintain a sell-on rally approach. So if you're looking to short the market at open, you should be cautious because we may probably, if assuming we're opening somewhere here, so wait for a pullback rally towards Friday's low, 17,250, 270 kind of a zone. If you open gap up, gap down here and hits the resistance zone, and again look for shorting opportunities. Okay. So another factor is, I think we covered dollar index, and let's look at the chart of crude oil. You can see US crude oil, you can see at outer end of Bollinger Band, and it's showing very strong momentum. There's a good chance it will go towards 100. So this is again a negative. So just be cautious. But one positive thing is the 10-year bond yields just dropped. But overall market structure is weak. So don't look to buy on any kind of dip. Look to short the market unless there's some kind of bottoming out process towards, if it all we come here or here and showing signs of bottoming out, that will be a good time to go long. Okay, but unless that's, again, we have to wait for confirmation. That's a long shot. But till February expiry, I'm looking to maintain a negative bias. That is my view. I hope you found the video useful. I hope you have a good week ahead. Take care and bye-bye.